7 Things to know before investing in bonds. Anyone wanting to invest their hard-earned money should first know the basics of what they're getting into. For example, you might think you're investing in a safe haven with bonds, but they can actually be even riskier than stocks in some cases. In this article, we'll outline what you need to know before making any decisions about bonds, and how to find out more if you still have questions. What are bonds? A bond is a debt investment in which an investor loans money to an entity, usually a government or corporation, for a set period of time. The entity pays the investor periodic interest payments, and at the end of the loan term, the entity repays the principal amount of the loan. Bonds are often used by governments and corporations to raise capital for various projects. For example, a government might issue a bond to finance the construction of a new highway. Or a corporation might issue a bond to finance the expansion of its business. Investors typically purchase bonds because they offer a predictable and consistent stream of income. Bonds also tend to be less volatile than stocks, so they can provide stability for an investment portfolio. Before investing in bonds, it's important to understand the different types of bonds and the risks involved. For example, corporate bonds tend to be riskier than government bonds, but they also offer higher interest rates. It's important to do your research and talk to a financial advisor before investing in any type of bond. Types of bonds. There are many different types of bonds that you can invest in. The most common type of bond is a government bond. Government bonds are issued by national governments and are considered to be very safe investments. However, they tend to offer lower returns than other types of bonds. Corporate bonds are another type of bond that you can invest in. Corporate bonds are issued by companies and typically offer higher returns than government bonds. However, they are also considered to be more risky investments. Municipal bonds are another type of bond that you can invest in. Municipal bonds are issued by local governments and usually offer lower returns than corporate bonds. However, they are considered to be much safer investments than corporate bonds. Finally, you can also invest in foreign bonds. Foreign bonds are issued by governments outside of your home country. They typically offer higher returns than domestic bonds, but they also come with more risk. Dividend, coupon, and interest rate. 1. Dividend. A dividend is a distribution of a portion of a company's earnings to shareholders. 2. Coupon. A coupon is the interest rate paid on a bond. It is generally fixed for the life of the bond. 3. Interest rate. The interest rate is the percentage of the bond's face value that is paid as interest. What is a bond ladder? A bond ladder is a strategy for investing in bonds. It involves buying bonds with different maturity dates, so that you have bonds maturing at different times. This gives you a steady stream of income from the bonds that mature, while still having money invested in bonds that will mature in the future. The main advantage of a bond ladder is that it helps to diversify your investment portfolio. By having bonds with different maturity dates, you are less likely to lose all of your money if interest rates rise. Another advantage of a bond ladder is that it can give you a higher rate of return than other investments, such as stocks or mutual funds. This is because bonds tend to provide a higher rate of return than other investments over the long term. The main disadvantage of a bond ladder is that it requires you to have a large amount of money to invest. This is because you need to buy multiple bonds in order to create a ladder. If you don't have a lot of money to invest, then this strategy may not be right for you. Bond maturity dates. When you invest in bonds, it's important to be aware of the maturity date. This is the date on which the bond will mature and the issuer will have to repay the principal amount of the loan. Bonds typically have a maturity date of 10, 20, or 30 years. It's important to know the maturity date of a bond because it can affect how much risk is involved. For example, a bond with a longer maturity date will typically be more risky than a bond with a shorter maturity date. This is because there is more time for something to go wrong and for the issuer to default on the loan. However, bonds with longer maturity dates also tend to offer higher returns. This is because there is more time for the issuer to make payments on the loan, which means that investors will receive more interest payments over time. Investors should carefully consider the maturity date of a bond before investing. They should think about their own risk tolerance and investment goals before deciding whether to invest in a bond with a longer or shorter maturity date. How to buy bonds. When it comes to buying bonds, there are a few things you need to know. First, you need to decide what type of bond you want to buy. There are many different types of bonds, each with their own set of benefits and drawbacks. You need to research each type of bond before making a decision. Once you have decided what type of bond you want to buy, you need to find a broker that deals in bonds. Not all brokers deal in bonds, so you may need to do some research to find one that does. Once you have found a broker, you need to open an account with them and deposit money into it. Now you are ready to start buying bonds. When you purchase a bond, you are essentially lending money to the issuer of the bond. In return, the issuer agrees to pay you interest on the loan and to repay the loan in full at the maturity date. Bond prices can fluctuate, so it is important to watch the market carefully before making any purchases. Investing in bonds can be a great way to earn extra income. However, it is important to understand how they work before getting started. Conclusion: bonds are a great way to diversify your investment portfolio and earn a stable return on your investment. However, there are a few things you should know before investing in bonds, such as the different types of bonds available, the risks involved, and how to choose the right bond for your needs. We hope this article has provided you with some useful information that will help you make informed decisions about investing in bonds. Thanks for watching. See you on the next episode.